Hello and welcome to Dukascopy TV. I'm Dermott at the Notz Stucki conference here in Geneva. Earlier today, I spoke to some experts on how to find the opportunity in the crisis. What type of opportunities are out there for your company during such a difficult time for Spain and for the Eurozone?
But we believe that despite a lot of countries having a lot of debt, there are also good positive spots out there, especially the emerging markets and particularly China, in which we believe that the growth of 7 to 8% becomes relevant globally because of the current size of the Chinese economy and because our Austrian school framework of thought in economics, we believe that the savings rate that the Chinese have make it a sustainable proposition for the next 10 years, irrespectively of the fact that they could have some dips. And that's sort of the water we navigate, a global GDP growth of 3 to 3.5%, which is okay for us. And the good thing is that because of all this turmoil related to Europe, we are presented wonderful opportunities at prices in the equity markets that would be otherwise unavailable.
Right, so we're a credit asset management shop, so we specialize in credit, and turns out that actually is a pretty good part of the asset allocation spectrum at the moment. The reason for that is because growth is pretty weak. In fact, Europe is going through a recession or about to have a recession at the overall Eurozone level. That means that core government yields are very low. The return for unit of risk that you get in that part of the fixed income market is actually pretty small and unexciting. So that is something we wouldn't advise many investors to go into, other than for complementary safety purposes. But if you look at credit on the other side of the fixed income market, especially in core countries, you get provided with a very significant risk premium. The likelihood of significant defaults in core countries and high quality corporates or global corporates or even financial institutions, large one based in the core countries in Europe, that is something where the risk premium you get versus the upside you get is very significant, and there's a lot in the price basically. So your downside, obviously there will be some volatility, but clearly there is one part of the risk spectrum where people want to allocate more capital because income is clearly becoming at a premium. You can see that in the way equities trade. High income equities have clearly started to outperform growth equities, especially in those regions like Europe. We think that trend is pretty strong. If you can get high and reliable income, that is something that will be at a premium for investors from here. So clearly, if you look at the parts of the credit markets where your systemic risk or downside risk is rather small, fundamentally, that is where you would want to be, basically.
Originally, your company depended heavily on profits made from investing in Spanish equities. Since 2007, when there was a dramatic drop in returns, and since then you have changed your views on the way you operate in your company. Can you tell me a little bit more about this shift and about how you invest at the moment?
We studied only in Spanish equities back in 1993, and up until 2003, we managed just 250 million, mostly all in Spanish equities. An international portfolio was studied in 1997, albeit in 2003 it only had 15 or 20 million, and then from 2003 on, we were fortunate enough that the performance accompanied us, and we had a huge inflows, also because the market situation was good, and these 12 million were turned into 4.5 billion in 2007. So we always have looked sort of international equities because while managing Spanish equities, as we are fundamental sector-driven analysts, we had to look at the competition of our companies outside of Spain. But the change occurred just naturally. We started replicating what we did in Spain in Europe, and the turn key points were 2003 when we started getting many more assets internationally. Now it's 20% of the assets are Spanish equities and 80% are international equities. Whether we've profited or not from the Spanish situation, which was the second part of your question, we as Austrian school followers, saw it coming, and we didn't have any bank or real estate or even domestically exposed business in Spain since 2003. So, well, despite not having any of those, from the peak of 2007, our Spanish fund is down 28%. But that compares to the IBEX 35, which is down 60%. So no one can eat relative performance, but at least we don't believe that we have suffered what we call permanent impairment of value, which is what one has to avoid. And we believe that we will recover relatively quickly because we are invested in sound domestically listed businesses, but which again have an export bias, and our portfolio since 2004 Spanish portfolio is based off exporters, pure exporters.
In your speech earlier, you spoke a lot about Ireland. Can you share with us your outlook on the Irish economy?
Well, over the next few months is obviously, Ireland is part of the Eurozone, so it's very tied to whatever is happening in the Eurozone. It's a more open economy than other economies in Europe, so maybe parts of that economy are more turned towards the world. But clearly it won't escape whatever is happening in the Eurozone. And there, we think that the growth trend is pretty clear. In the second half of 2012, it's extremely likely to be, a time of recession for the whole of Europe. Ireland won't be spared. And that, that's the bad news, if you want, but it's kind of already somewhat expected. Now, on the good side of the equation for Ireland is the fact that clearly the last week's news at the EU summit with bank recaps being now done at the ESM level and directly into the banks without having to go through the sovereign means that they are likely to re-examine the Irish situation, where clearly that burden had to be borne by the local state. So it is very possible that actually the overall debt to GDP in Ireland goes down, as you're talking a few tens of billions of euros of loss being borne by the Irish sovereign because of the banking situation and the recapitalization. That might be mutualized at the European level, reduce the burden on the Irish sovereign, which makes the perception of the Irish sovereign, especially after all the policies that have been implemented over the last 2 to 3 years, a much healthier perception in the markets. And that is where we think that potentially Ireland could be coming back to retest the capital markets over the next 1 or 2 years. And that, in terms of a show of confidence, we think would be quite positive.
There's been a record high in unemployment in the Eurozone. Many expect an ECB rate cut at this week's meeting. What do you expect?
When interest rates are at 1%, I don't know if making them 0.5 or whatever will solve any problem. We don't think that's a way to solve the problem. We believe that if you want to really solve the problem, but that's biased to our Austrian view of the world, which is, we may be wrong, but that's the one we have and the one that has worked for us. You have to reduce public spending. You have to reduce public spending to a level when you could even reduce taxes instead of increase taxes. You have to liberalize all of the sectors, all the markets, and make it friendly for the entrepreneur to create business, because it's the entrepreneur that creates the jobs, not the state. And if you do all that, if you reduce taxes, reduce public spending, and liberalize all the markets, all the workers that have mistakenly gone to those part of the structure of the production where the bubble was, real estate in Spain, these workers can migrate to other parts of the structure of the production of the economy. And for that migration, you need incentives for the entrepreneur to create those jobs, and you need liberalization of markets for those people, being able to be fired here and hired here. And that's unfortunately only part of the things that have been undertaken. But what's good is that the German pressure goes in that direction. So whether the pace is going to be quick or slow, we don't know. But we don't believe that easing is the solution. Easing could be a solution if there is a bank run, if there is technical problems with financial entities, but it's not the solution for employment to grow.
That's all we have time for from the Notz Stucki conference. Thank you for joining us today, and stay tuned to Dukascopy TV for the latest financial news.